Hello and welcome to Module 5 of Pepperstone's Intermediate Trading course, Psychology and Risk Management. In this section, we will look at the different types of orders you can place in the market and examine which type of order best fits the trades that you are going to enter, as well as managing the expectation of the entry points. In this lesson, you will learn the 6 order types available to traders. How to place trades using market orders, how to place trades using limit orders, and how to place trades using stop orders. When you have done your market analysis and decide which instrument and direction you are going to trade, it isn't always as straightforward as placing a buy or sell order. There may be instances where you have decided on an entry level that price has not yet reached, or you may be waiting for an area of support or resistance to be broken before entering your position. Although buying and selling at the current level is easy to execute, this style of entry may not always be the best option. There are 6 different types of orders that can greatly assist you in getting into the market at a point into the future, and all have different characteristics that are suited to particular market conditions. Let's first take a look at market orders. A market order is used when a trader intends to buy or sell an instrument at the best available current price. These types of orders are generally executed immediately, as you have no set parameters around price limits or timeframes. Brokers generally offer market prices using a bid price and an ask price. The bid price will always be lower than the ask price, with the differences in the two prices referred to as the spread. When a market executed buy order is placed, the trader is willing to pay the ask price, and when a market sell order is placed, the trader is willing to accept the bid price. When you want to place a buy market order, you are essentially entering a position long at the current market price. You will use this type of order if you predict that the market will be going up from around the current level. The order pad that you can see on the screen is from the MetaTrader 4 platform, generally regarded as one of the world's most popular platforms. Although they don't all look the same, most order pads on different platforms should give you the same functionality. You can see in the top green box that market execution is selected. The second green box highlights the ask price, and as this trade is placed to go long, this is the price that you will get if the liquidity is there to fill it. The final green box highlights the buy by market button, which once pressed will execute this trade. In a real example, you may see price consolidating at a level of support that you think will hold, so you would want to enter the market at this point with no delay. This type of trading environment would warrant using a market buy order, because if the entry is delayed, you may miss out on an opportunity. Also, you don't believe that price is going any lower, so it would make sense to enter at this level without delay. When you want to place a sell market order, you are essentially entering a position to go short at the current market price. You will use this type of order if you predict that the market will be going down from around the current levels. You can see in the top red box on the screen that the market execution is selected. The second red box highlights the bid price, and as this trade is placed to go short, this is the price that you will get if the liquidity is there to fill it. The final red box highlights the sell by market button, which once pressed will execute this trade. In the real example we see on the screen, you may see price struggling to break a level of resistance that you think will hold, so you would want to enter the market at this point with no delay. This type of trading environment would warrant using a market sell order, because if the entry is delayed, a trading opportunity could be missed. Limit orders are used when a trader intends to buy or sell an instrument at a price in the future that is better than the current price. Although the limit price that is set by the trader is guaranteed, these types of orders aren't guaranteed to execute, as price has to reach the specified price level for the order to be filled. Another option that is available with limit orders is choosing how much time you will give the market to reach your intended price point. Two of the most common time periods are Good 4 Day, which is abbreviated to GFD on most platforms, or good till cancelled, which is abbreviated to GTC in the settings. When you use a buy limit order, you are attempting to buy at a price that is lower or better than the current price. There are a few reasons why you could use this method, but the most likely one is that you have identified an area of support that price is still above. You would expect that level to hold if price gets there and then move up. You can see on the example on the screen that the order window looks similar to the market order window. The first green box contains the order type, where pending order is selected. The second green box has a buy limit selected from the drop-down menu, and the third green box has the price that you would like to buy at. In the real example we can see on the screen, you can see this process in action. You can see that the green support line on the chart may provide an expected level of support, and you would like to buy if price reaches it. Rather than sit in front of the chart and wait, a buy limit order can be placed at the support price, and the market can be given the time to do its thing. When you use a sell limit order, you are attempting to sell at a price that is higher or better than the current price. Again, there are a few reasons why you would use this method, but the most likely is that you have identified an area of resistance above the current price level. You would expect that price may halt if it reaches that zone and move down from the resistance. You can see in the example on the screen that the order window looks similar to the market order window. The first red box contains the order type, where pending order is selected. The second red box has a sell limit selected from the drop-down menu, and the third box has the price you would like to sell at. In the real example we can see on the screen, you see this process in action. You can see the red resistance line on the chart, which may provide an expected level of resistance, and you would like to sell if price reaches this level. Rather than sit in front of the chart and wait, a sell limit order can be placed at the resistance price. Finally, let's have a look at stop orders. Buy stop and sell stop orders also execute after a specified price point has been reached. Stop orders work in the opposite way to limit orders, as stop orders actually give you a worse price than the one currently available. When you use a buy stop order, you are attempting to buy at a price that is higher or worse than the current price. There are a few reasons why you could use this method, but the most likely is that you have identified an area of resistance that you would like to see broken before you attempt to go long, expecting that price would continue if it breaks that zone. You can see in the example on the screen that the order window looks similar to the market order window. The first green box contains the order type, where pending order is selected. The second green box has the buy stop selected from the drop-down menu, and the third green box has a price that you would like to buy at. In the real example that we can see on the screen, we can see this process in action. You can see that the red resistance line on the chart may provide an expected level of resistance, and you would like price to break that zone before entering a long position. Rather than sit in front of the chart and wait, a buy stop order can be placed just above that resistance line. The alternative is to say that close enough is good enough and just enter long with a market execution. In some instances, where the distance is not far away, this may be a practical option, but on the larger time frames, what appears to be a small gap could be more than 50 pips, and this may mean you have to use a larger stop loss, consequently making you trade a smaller lot size unnecessarily. When you use a sell stop order, you're attempting to sell at a price that is lower or worse than the current price. Again, there are a few reasons why you would use this method, but the most likely is that you have identified an area of support below the current price level. You would expect that price may halt if it reaches this zone, and eventually break through and continue moving down. You can see in the example on the screen that the order window looks similar to the market order window. The first red box contains the order type, where pending order is selected. The second red box has a sell limit selected from the drop-down menu, and the third box has the price that you would like to sell at. In the real example that we can see on the screen, you can see this process in action. You can see that the red support line on the chart may provide an expected level of support, and you would like price to break that zone before entering a short position. Rather than sit in front of the chart and wait, a sell stop order can be placed just below the support line. Once again, the alternative is just to enter short with a market execution, but by using that approach, you run the risk that the support level will once again hold and reverse the market up. By placing the order below the support, you are allowing the market to break the line first, with your order at no risk, as it hasn't yet been triggered. Now, although you are getting a lower sell price, you are getting a trade-off that a significant support level has been broken before you enter, which gives your trade a greater chance of success. In this lesson, we have learnt about the 6 order types that are available to traders. We have learned how to place trades using market orders. We've learned how to place trades using limit orders. And finally, we learned how to place trades using stop orders. This concludes section 1 of Psychology and Risk Management. In the next section, I will explain how to find and use the correct stop loss and take profit zones for your trades. These important levels will ensure that you give your trades the best chance of success without exposing you to unnecessary risk. Hello and welcome to Module 5 of Pepperstone's Intermediate Trading course, Psychology and Risk Management. In this section, we will look at the different ways stop loss and take profit zones can be calculated. We will examine the different trading techniques and explain the correct stop loss and take profit levels for each of the patterns. In this lesson, you will learn the golden rules of stop loss and take profit zones. You will learn where to place stop loss and take profit zones for channels and topping patterns. You will learn where to place stop loss and take profit zones for triangles, flags and pennants. And you will learn how to use dynamic stop loss levels in trends. In many ways, correct take profit and stop loss zones define how successful a strategy can be. And if used incorrectly, a potentially good strategy could be brought undone unfairly. 2 of the most common mistakes traders make is placing their stop loss too close to the entry point and having their take profit target at an unrealistic level, which makes it very difficult for trades to be successful. You may have heard of the saying that you should cut your losses short and let your profits run. Unfortunately, a lot of traders do the opposite, cutting their profits short and letting their losses run. As difficult as this is to believe, traders often fall into this trap, but it is easy to avoid if you follow 2 simple rules. Rule number 1. Once you identify a correct stop loss level, once the trade is placed, you must never increase the stop loss level. Stop loss levels are the hallmark of risk management, so if you make a stop loss level greater after a trade is placed, you are immediately increasing your risk. And rule number 2. Once you identify a correct take profit level, you never take your profit early unless there is a technical reason to do so. Many traders fall into the trap of thinking they have made a good profit from a trade, so they take their profits early. By doing this, traders are sabotaging their trades by not allowing them to reach their full potential. The only reason you should ever take a profit early is if there is a fundamental or technical shift in the market, which may cause the market to behave in a different manner to when you first placed the trade. Using stop loss levels is the only way you can manage risk correctly when trading, so it is imperative that stop loss zones are given the attention they rightly deserve. As important as take profit and stop loss zones are, the great news is that there is a set of rules that you can follow to take the guesswork out of where they need to be placed. Let's first take a look at stop loss and take profit zones for channels and topping patterns. One of the easiest ways to place a good stop loss level is to identify any potential barriers that price will have to get through in order to stop you out, and then place your stop loss order behind it. Almost like a protective shield, the more obstacles you can put between your entry point and your stop loss, the better chance it will have of surviving market noise. Barriers such as moving averages and previous highs and lows can provide good protection, as can support and resistance zones from previous market movement. Let's take a look at how we use stop loss and take profit zones for channels. As you can see in the example on the screen, if you are taking a long position at an area of support, it is always a good idea to give it a stop loss of at least 20% of the expected move, or just below the lowest recent low, whichever is greater. As an example, if you have a projected take profit of 100 pips, you would have a minimum 20 pip stop loss, or if the more recent low was greater than 20 pips, it would be placed just below that level. The take profit level can vary greatly, and will depend on what type of market you are trading. If the market is trending, then take profits are going to be far bigger than take profits in directionless markets. As a general rule, if your trade doesn't have a defined take profit level from a chart pattern, then you would place it just below the first level of resistance in front of your entry point. This is the opposite of how you would deal with a stop loss, as when you are trying to identify a good take profit level, you are looking for the easiest path. The less obstacles there are between your entry point and the take profit level, the better chance that your trade will be a success. As you can see in the example on the screen, the take profit would be placed just below the first area of resistance. The same rule applies when you sell at a resistance point, where the stop loss is placed at least 20% of the expected move above your entry point, or just above the highest recent high, whichever is greater. For example, if you have a projected take profit of 200 pips, you would have a minimum 40 pip stop loss, or if the most recent high was greater than 40 pips, it would be placed just above that level. The same general take profit rule applies when shorting the market. If your trade doesn't have a defined take profit level from a chart pattern, then you would place it just above the first level of support below your entry point, as you can see in the example on the screen. All of the chart patterns discussed in this trading course have predetermined take profit and stop loss levels, which adapt dynamically to the time frame and pattern that you are trading. This basically means that the rule for a pattern will remain the same no matter what time frame you are trading, as the size of the pattern dictates where the stop loss and take profit needs to be placed. Let's now take a look at stop loss and take profit zones for double tops. To calculate the stop loss for a double top, you measure the height from the neckline to the highest peak, and place the stop loss 10% of this distance above the highest peak of the formation. The take profit is calculated as the distance from the neckline to the highest peak, as demonstrated in the example on the screen, and this is extended down from the entry point. To calculate a stop loss for a double bottom, you measure the height from the neckline to the lowest trough, and place the stop loss 10% of this distance below the lowest trough in the formation. The take profit is calculated as the distance from the neckline to the lowest trough, and as you can see in the example, the measurement A should always equal B. Now let's take a look at stop loss and take profit zones for head and shoulders patterns. To calculate the stop loss in a head and shoulders pattern, you measure the height from the neckline to the top of the head inside the pattern, and place the stop loss 10% of this distance above the right shoulder, as you can see here in the example. The take profit is calculated as the distance from the neckline to the top of the head, and projected below the entry point. To calculate the stop loss for an inverse head and shoulders, you measure the height from the bottom of the head to the neckline inside the pattern, and place the stop loss 10% of this distance below the right shoulder, as you can see here in the example. The take profit is calculated as the distance from the neckline to the bottom of the head, and projected up from the entry point. Again, the distance A should always be the same distance as B. Let's now take a look at stop loss and take profit zones for triangles, flags, and pennants. Take profit levels on symmetrical triangles that break long are measured from the base of the triangle as demonstrated in the example, and projected up from the break zone at the upper line. You place a stop loss of a symmetrical triangle 10% of the take profit distance below the lower band of the triangle, at around the same vertical distance from the break zone. The same rules apply to symmetrical triangles that break short, only in reverse. The take profit level is measured from the base of the triangle and projected down from the break zone at the lower line. You place your stop loss 10% of the take profit distance above the upper line of the triangle, at around the same vertical distance from the break zone, as we can see here in the example. Take profit levels on ascending triangles are measured from approximately 2/3 of the maximum height of the triangle, as we can see here, and projected up from the break zone at the horizontal top line of the triangle. You place a stop loss 10% of this distance below the lower sloping band of the triangle, at around the same vertical distance from the break zone. Take profit levels on descending triangles are measured from approximately 2/3 of the maximum height of the triangle, and projected down from the break zone at the horizontal bottom line of the triangle. The stop loss is placed 10% of this distance above the upper sloping line of the triangle, at around the same vertical distance from the break zone, as you can see here in the example. Now let's take a look at stop loss and take profit zones for flag patterns. To work out the take profit level of a flag in an uptrend, you measure the distance between the top of the consolidation area where the pole first broke out to the top of the flagpole before the consolidation inside the flag started. The expected take profit for this pattern will be the same distance, and you measure this from the top of the flag where the breakout occurred. The stop loss is placed 10% of the take profit distance below the bottom of the flag formation. Measuring the take profit level on a flag pattern in a downtrend is done in much the same way, where you measure the distance between the bottom of the consolidation area where the pole first broke out to the bottom of the flagpole before the consolidation started. The expected profit for this pattern will be the same distance, and you measure this from the bottom of the flag where the break occurred. The stop loss is placed 10% of the take profit distance above the top of the flag formation, as illustrated in the example. To work out the take profit level of a pennant in an uptrend, you measure the distance between the top of the consolidation area where the pole first broke out to the top of the pole before the consolidation inside the pennant started. The expected profit for this pattern will be the same distance, and you measure this from the top of the pennant where the breakout occurred. The stop loss is placed 10% of the take profit distance below the bottom of the pennant formation, at the same vertical level as the breakout. Measuring the take profit level on a pennant pattern in a downtrend is done in much the same way, where you measure the distance between the bottom of the consolidation area where the pole first broke out to the bottom of the pole before the consolidation of the pennant started. The expected profit for this pattern will be the same distance, and you measure this from the bottom of the pennant where the breakout occurred. The stop loss is placed 10% of the take profit distance above the top of the pennant formation at the same vertical level as the breakout. Dynamic stop loss zones in an uptrend, such as uptrend lines and sequences of higher highs and higher lows, have predefined stop loss rules, but no take profit rules, as an uptrend can continue for extended periods of time and take profits should not be capped. As the example on the screen demonstrates, to work out a stop loss level for an entry of a trend line or higher trough, you measure the height of the previous peak to the entry point, and place a stop loss 15% of this distance below the entry point. This method is also market adaptive, because each of the individual moves are measured and calculated accordingly, giving the stop loss levels a good chance of not being reached as long as the trend continues. Dynamic stop loss zones in downtrends are calculated in a similar way. Downtrend lines and sequences of lower highs and lower lows have predefined stop loss rules, but again, no take profit rules, as downtrends can continue for extended periods of time, and take profits should not be capped. As we can see with the example on the screen, to work out the stop loss level for an entry in a downtrend line or lower peak, you measure the height of the previous trough to the entry point, and place the stop loss 15% of this distance above the entry point. Using these stop loss and take profit rules in your trading will give your trades a good chance of being successful, and will allow you to control your risk on every trade that you place. In this lesson, we have learnt the golden rules of stop loss and take profit zones. We have learnt where to place stop loss and take profit zones for channels and topping patterns. We have learnt where to place stop loss and take profit zones for triangles, flags, and pennants. And finally, we learned how to use dynamic stop loss levels in trends. This concludes section 2 of Psychology and Risk Management. In the next section, we will look at how to use the correct contract or lot sizes for the trades that you're attempting to place. This important section will show you how you can manage risk and help you achieve your desired results on the trades that you place. Hello and welcome to Module 5 of Pepperstone's Intermediate Trading course, Psychology and Risk Management. In this section, we will look at contract and lot sizes and how they interact with leverage. We will examine how leverage can be used to increase the volume of your trading, and most importantly, how to protect yourself from its dangerous pitfalls. In this lesson, you will learn how to interpret contract and lot sizes, how contract sizes in foreign exchange differ from the stock market. We will look at the mechanics of how leverage works, and we will look at the ways that you can use leverage to your advantage when you're trading. Once you have carried out your trading analysis and decided where you think the market is going, you need to make one of the most important decisions in the whole trading process. How much do I put on? Choosing the correct contract size for your trade is an extremely important cog in any trading plan, as it is this decision that ultimately separates professional traders from the rest. If you don't get this part of the process right, it makes little difference how solid your trade plan is, or indeed where you place your stop loss and take profit levels. As you have probably guessed, choosing the correct contract or lot size to trade is directly related to risk management. Many traders wrongly assume that having a stop loss at the correct level is all that is required to maintain risk management. In reality, the true function of a stop loss is to ensure that if your trade plan for a particular trade fails, your losses will be capped. A stop loss placed in the correct area will be of little use to you if the size of your trade was so big that you lose half of your account balance. Another common mistake made by traders is choosing a contract size to trade and then placing a stop loss level based on a set dollar amount. As an example, a trader might choose to trade a standard contract on the Aussie USD and only risk 1% of their account, thinking that they are applying good risk management rules, and then work the stop loss back so they can only lose 1%. Now, although risking only 1% of your trading account on a particular trade is good risk management, placing a stop loss level to suit the contract size is very wrong. A stop loss level needs to be where the market determines it needs to be, not the other way around. It is the contract size that needs to be adjusted to fit the correct stop loss level, and the combination of the two, working hand in hand, is what true risk management is about. Let's now break down lots to a dollar value. The terms contract and lots can be generally used interchangeably and represent the volume of the instrument a trader is investing. In the foreign exchange markets, a lot represents 100,000 units of the base currency. As an example, if a trader was to buy one lot of the Aussie USD currency pair, they would essentially be buying a position in the Aussie USD valued at $100,000. If the current price of the Aussie USD pair was 80 cents, one lot would equal 100,000 Australian dollars. Now, if this pair increased in value to 82 cents, the initial investment of 100,000 Australian dollars would now be worth 102,000 Australian dollars. If the Aussie USD increased in value to $1, also known as parity, the trader's investment would be worth 120,000 Australian dollars. One of the great things about the foreign exchange market is that most brokers offer contract sizes that are considerably smaller than one standard lot. Traders in this market have the ability to trade as little as 0.01 lot size, also known as a micro lot, which equates to 1,000 units of the base currency. Using the example of the Aussie USD pair we used earlier, the same trade would equal $1,000. Again, if the Aussie USD pair increased in value to 82 cents, the initial investment of $1,000 would be worth $1,020. Now let's take a look at the contract differences between foreign exchange and the stock market. The ability to be able to basically trade any size contract is a great advantage to traders, and unlike the stock market, which has a minimum brokerage fee placed on a trade, foreign exchange brokerage is calculated as a percentage of the size of the trade. For example, let's look at a trader who wants to purchase a share in one of the most popular companies in Australia, BHP, at the current share price of $25. There is a minimum brokerage fee attached to a stock market trade, which then moves to a percentage-based system after a certain amount of value. The minimum brokerage and clearing fees with most brokers is around $25. This means that if a trader wanted to purchase one share in BHP, it would cost them $50, $25 for the share, and $25 for the brokerage and clearing fees. If that same trader took a long position on the Aussie USD at 80 cents with a 0.01 lot size, assuming the spread was 2 pips, the equivalent brokerage charge would be 20 cents. Now, to bring these two trades into perspective, you need to see what would happen if there was an increase in each of the underlying asset values. If the share price of BHP increased by 5%, the share would now be worth $26.25, a profit of $1.25. And if the Aussie USD increased by 5%, the pair would now be worth 84 cents, a profit of around $40. Now, of course, the risk on both trades is completely different, and in no way represents a comparable trade. But the exercise is designed to demonstrate how much a trader can scale into a trading position for any account size without paying excessive brokerage when trading foreign exchange. To equalize these two trades, all a trader would have to do is place a stop loss of 5 cents, or at a level of 75 cents on the Aussie USD trade, and the worst potential loss for both trades would be $50. Now let's take a look at the mechanics of leverage. One of the biggest advantages of trading in the foreign exchange market is the leverage that is available to traders. As you are probably aware, trading in the stock market is fine if you have a balance large enough to be able to place trades that justify the brokerage costs. Although margin loan facilities and line of credit arrangements are available to stock market traders, the highest amount of leverage available is usually limited to 75% margin, or 3 to 1. This means that a trader with a balance of $10,000 could have a facility in place to hold assets valuing 3 times that amount, up to $30,000. In the foreign exchange and derivative markets, leveraged amounts available to traders are at a totally different level, where some brokerages offer as much as 400 to 1. To put this into context, let's look at the previous example to explain what this means to your required trading balance. If a trader was holding the Aussie USD without leverage, holding one lot would require 100,000 Australian dollars. Holding 0.1 lot would require $10,000, and holding 0.01 lot would require $1,000. Now, if we bring leverage into the equation, it would look more like this. At 100 to 1 leverage, $99,000 would be put up by the broker, and $1,000 would be required in your trading account to equal $100,000 market exposure. If we increase the leverage amount to 200 to 1, the broker would be putting up 99.5% of the money, or $99,500, and all that is required in your trading account would be $500, which would equal $100,000 exposure. As you can see from these examples, the power of leverage gives traders the ability to hold considerably large positions with relatively small balances, which is why traders are so attracted to this type of trading instrument. On face value, the power of leverage is an amazing mechanism that gives traders exposure to large amounts of volume, which can greatly enhance their returns on profitable positions. Of course, on the flip side, the power of leverage also greatly enhances trading losses when the markets move against the trader. So where is the balance? In essence, using leverage is just another tool available to traders, and when it is used in the correct manner, can greatly enhance a trader's profitability. In fact, trading instruments like currency would be a very difficult proposition if leverage was not available. To explain this, I will take you back to the example I touched on earlier. If a trader was to take a long position in the Aussie USD at 80 cents with a standard lot size, they would be required to contribute around $100,000 just to hold the position. Now, although currency can be volatile at times and can move significantly in trends, for the most part, it can spend a lot of time in trading channels, fluctuating only small amounts. A 10% move in the Aussie USD would require the pair to move from 80 cents to 88 cents, or 800 pips, to net a profit of around $8,000. Assuming an investment horizon of 1 year, from a value standpoint, that is a lot of money to have locked into a position, waiting for a move that in currency terms would qualify as significant if the pair wasn't in a heavy trend. Assuming that a 5% stop loss is in place, the most a trader would stand to lose on this trade is $5,000. If we factor in that the same trader could have used leverage at 100 to 1, the trade would look more like the column on the right. A balance of $7,000 would provide enough margin to place a long position on the Aussie USD at 80 cents, with a stop loss set at 5%. If the Aussie USD increased in value 10%, all things being equal, the trader will make around $8,000. And if it were to decrease in value by 5% and hit the stop loss, the trade would lose around $5,000. Both of these trades have the same risk and reward applied, with a potential gain of $8,000 if the take profit was reached, and a potential loss of $5,000 if the stop loss was hit. The difference is that the trade that uses 100 to 1 leverage has given the trader the opportunity to redistribute $93,000 and maintain the same exposure. As you can see in the example on the screen, if the trader was to place the remaining $93,000 in a term deposit for 1 year at a 4% return, they would receive a guaranteed interest payment of around $3,700. This makes the total risk on the trade $1,300 for a potential reward of $11,700, which is made up of the $8,000 the trader would make from reaching the take profit target on the trade and the $3,700 they're going to receive in interest. Now, these calculations have not factored in brokerage or any fees, but are simply designed to illustrate the power of leverage when used correctly. Although this is a very basic example of how leverage can be used as an investment tool, you will notice that the example traded a standard lot in the account that had a balance of only $7,000, risking a potential $5,000, and therein lies the danger of using leverage. If a trader only had $7,000 available to trade with, this size of trade would be foolhardy to say the least, as the worst case scenario would devastate the trading balance on one trade. The example highlights how beneficial using leverage as part of your trading strategy can be when used sensibly with the correct risk management. In this basic example, using leverage gave a trader the chance to be exposed to a large position in the market, while at the same time reducing the worst case risk further through a safe investment vehicle like a term deposit. When using leverage as part of your trading strategy, it is always important to remember that the extra exposure can work for you and against you, but if you have the right risk management process in place, this fantastic tool can greatly enhance your ability to reach your trading goals. In this lesson, we have learned how to interpret contract and lot sizes. We have learned how contract sizes in foreign exchange differ from the stock market. We have learned how the mechanics of leverage works. And finally, we learned how you can use leverage to your advantage. This concludes section 3 of Psychology and Risk Management. In the next section, we will look at the psychology of trading, one of the most important factors of any successful trader, and a non-negotiable element of all trading plans that will stay the distance. Hello and welcome to Module 5 of Pepperstone's intermediate trading course, Psychology and Risk Management. In this section, we will examine the role psychology plays in the ultimate success or failure of a trader, and give you tips on how to avoid the common pitfalls that plague most traders. In this lesson, you will learn the emotions that you can expect to encounter when trading, how to manage the individual risk of each trade, the importance of good risk-reward ratios, and what behaviours to avoid when placing trades. Let's first talk about managing emotions. As important as all of the information that you have learnt so far in this course is, it will not amount to much if you fail to integrate the correct psychology into your trading plans. Many traders believe that a good trading strategy is all that is required to make money in the markets. But I can assure you that if you don't incorporate the correct mindset, your trading journey may not end up at the destination you are hoping for. If a definition was applied to trading psychology, it would read something like, a trader's ability to allow human emotions to dictate the success or failure of their trades. In fact, there are 4 important characteristics that a trader must possess to be successful. Emotions, A trader must be able to control their emotions while executing their trade plans. Discipline. A trader must maintain complete discipline throughout the trading process. Perspective. A trader must maintain a clear perspective when placing trades. And adaptive. Traders must be able to adapt to the changing markets and adjust their market vision accordingly. It is reported across the investment industry that 95% of people attempting to become professional traders fail, and only the remaining 5% are actually successful. Now, although this value is in no way verified, it would not surprise me if it was close to being accurate. At first, this may seem very disheartening to think that you have a 95% chance of failure, and common sense would probably lead you to run as fast as you can away from investing, but you must put these numbers into perspective first. It is widely acknowledged that the majority of the 95% of aspiring traders are not educated in the discipline to begin with, and the ones that are choose an education path that guarantees some sort of grand scale success and huge profits. I'm sure many of you have heard of the adage, if it sounds too good to be true, it probably is, and this certainly applies to trading. That said, the fact that you have reached this level of the course should have you well placed and ahead of the game in terms of education, because as you have probably already worked out, this course is not a get-rich-quick scheme with a pot of gold at the end of the rainbow. Rather, it is a process to help you understand the fundamentals of what is required to be a successful trader. So far, this course has focused on arming you with the tools that you need to trade successfully, and with this final part of the puzzle, the only thing that can stand in your way of being a successful trader is your trading psychology. One of the most important components of trading psychology is your ability to manage risk. Many traders believe that risking a certain percentage of their account per trade is managing risk, and for the most part, it is. The problems that most beginners face is that the risk management component starts out with good intentions, only to fail them when they need it most. There is no right or wrong contract size when it comes to placing trades, as each individual account will have varying balances. A great risk management approach is to risk only a portion of your account per trade, say 1%. Again, in theory this would work, but what many traders choose to do is risk 1% per trade, but have 10 trades open at once. And if that prospect isn't worrying enough, many of these trades will correlate to each other. The example that we can see on the screen shows a trader risking only 1% per trade, with a bias to a weakening US dollar. They have short positions placed on the USD Yen, the USD CAD, and the USD Swissy currency pairs, and long positions on the Euro USD, Aussie USD, and Pound USD currency pairs. Although this trader has only risked 1% per trade, if their bias of the US dollar weakness is wrong, all of these trades are likely to fail because there is no diversification. If the US dollar strengthens significantly, all of the longs are going to have their stop losses taken out, as will the short positions on the USD-based pairs. The thought of having your account down 6% should not be daunting, but this type of trading pattern will lead to far bigger losses down the track. Another misconception that traders have is if they lose 50% of their account, they only have to make 50% back to be square again. The example that we can see on the screen now shows how much percent you actually have to make back to get to a break-even position after a drawdown. As you can see, if an account gets down to 50% of its initial balance, you'll have to make 100% return on the remaining balance to bring it back to where you started. If a trader was risking only 1% per trade, and now only has half of their starting account balance, then a number of things may have gone wrong. They may have risked the wrong amount on a trade and taken a significant hit to their account. They may have risked the right amount and exercised poor diversification techniques as discussed earlier, or they could simply have a very poor trading strategy. Regardless of the reason as to why the account is there, if 95% of traders fail at becoming successful traders, 99.9% of traders will most likely fail at resurrecting this account back to a profitable position using a correct risk management approach after sustaining such a loss. The reason for this is simple. Aside from the fact that there could be something fundamentally wrong with their trading methods, the odds are stacked so far against this trader that they will be overwhelmed with the prospect of what is required to get back to a position where they started, using sound risk management techniques. Some of the biggest fund managers in the world, who have teams of analysts, experts, and every conceivable resource, aim to outperform a major index as a benchmark. Now, on average, most indices will achieve around 5 to 7% per annum return when averaged out over rolling periods of 10 years or over. For this example, let's say that a good fund manager will outperform the index by a net 3% per annum every year. And let us also assume that the index will have an optimal year every year. Although both scenarios are highly unlikely, let's assume that the fund manager consistently nets a 10% per annum return. As you can see with the example on the screen, if you factor in a compounding account balance, where no withdrawals are made, it would take this fund manager more than 7 years to make a 100% return. Our trader will have to consistently perform as well as this fund manager, who has all the resources and expertise at their disposal for more than 7 years just to get the account balance back to where it started. What inevitably happens is this same trader will attempt to take extra risk to get themselves out of this predicament by increasing their trading size. It is most likely that the trader will proceed to take this account to zero, or what sometimes is a worse scenario, get lucky and quickly recoup their losses. Now, although that sounds like a good situation to be in reality, this trader has taken what would be extraordinary risk to get themselves out of a hole, and will probably feel that they have beaten the market. This same trader will soon realize that they may have escaped this time, but sometime in the future, when they attempt the same process, the market will show them why this is not a sustainable model. If you do find yourself in a situation where you have made a mistake with a lot size, and you have taken a large loss that otherwise would not have had this effect on your account, a better way to deal with this is to replenish your account with the loss amount if you can afford to do so, and start the balance where it was before the error. Now let's take a look at risk-reward ratios. In terms of trading, risk-to-reward ratios can be described as how many units of reward there are for each unit of risk. For example, if you apply a risk of 1% per trade, and the take profit is set to 4%, then you have a risk-reward ratio of 1 to 4, 1 part risk for 4 parts reward. Risk-to-reward ratios are generally set around 1 to 1, 1 to 2, 1 to 3, 1 to 4, and 1 to 5. You should never enter a trade that has a reward smaller than the initial risk, as the win ratios to make these types of strategies successful are very difficult to maintain. Strategies with higher ratios, such as flag patterns and moving average crossovers, can be profitable with lower win ratios. For example, a flag pattern generally has a 1 to 4 risk-reward ratio because of the way the stop losses are placed compared to the projected take profit. As you can see in the example on the screen, on a low risk-reward strategy, you need to have more winning trades than losing trades to make a profit in the long run. When using strategies that don't require high win rates, like flag patterns and moving average crossovers, you can actually have more losing trades than winning ones, and make the same profit or more over time. Some of the most successful people in the world are investors and traders, but they didn't just get there because they were lucky, as luck can only hold you up for a certain amount of time. The most successful traders have amazing discipline to execute their trade plan and make smart decisions. You need to be mindful that not every trade you place is going to work out, but what will make you successful is how you handle the losses and the downtimes, because the good times will take care of themselves. The key is to ensure that you maintain the discipline to follow through with your trade plan. Now, although allowing emotional involvement can have a positive impact in many aspects of life, trading is not one of them. In fact, the key to becoming a successful trader is to try to keep emotions completely out of any part of your trading decisions. Some of the biggest issues that traders have when it comes to trading psychology generally play out in the same fashion, and can be attributed to a handful of undesirable behaviours. Greed is an emotion that many traders don't believe they are affected by. These traders will set unrealistic goals because they try to take out of the market what they want rather than what is achievable. More often than not, this type of attitude leads to traders not taking profits at the correct areas because they haven't made enough money, or they want a little bit more out of their trade. This is yet another example as to why you need to leave your emotions at the door when you are preparing to trade, as any interference to a sound trade plan is simply sabotaging your chances of becoming a successful trader. Fear is an emotion that creeps up on traders without them knowing it until it is too late. It generally comes in the form of not wanting to take a loss on a trade because they are afraid of losing money. I'm sure that you have all heard of the saying, "You must spend money to make it," and in a sense, trading is no different. As I mentioned earlier, you will not make money on every trade that you place, so you must be able to deal with the fact that some of the trades that you will place will simply not work out. Many traders fall into the trap of refusing to take a loss, and rather than using a stop loss to mitigate risk, they let their losses run in the hope that the market will turn around. I can confidently tell you that if you are wishing and hoping at any stage of your trade, you need to get out immediately. When you combine the right psychological mindset with other risk management tools in this module, you will see how the pieces fit together to provide the blueprint for success. Remember that this course has given you all of the tools that you need to be in the top 5% and become a successful trader. But how you use them and the effort you put in will ultimately determine your success. There are no get-rich-quick schemes in professional trading, and only hard work and commitment will get you where you want to be. This concludes Section 4 of Psychology and Risk Management. We hope that you have enjoyed your journey throughout this course. If you have any questions or would like to discuss any of the concepts that we have worked through, please do not hesitate to contact your Pepperstone trading specialist for further guidance.